When it comes to investment, mutual funds are an excellent option. But not everyone has the capacity to take on the risk involved in investing in equity mutual funds. If you can afford it, then debt mutual funds would be the right choice for you. Debt mutual funds offer a highly secure option for investment. While they carry a risk comparable to equity mutual funds, their returns are slightly lower than equity funds. This follows the rule of mutual funds. Higher the risk, higher the returns. The debt market facilitates the buying and selling of loans in exchange for interest. Large companies in India issue debt securities in this market for various purposes, such as expanding their businesses or for other reasons. Debt mutual funds purchase these debt securities. Investing in debt mutual funds can be understood in a way that you are providing loans to prominent businessmen in India such as Ambani, Adani, and Tata, and in return, you receive interest at a predetermined rate every month. In addition to these mentioned options, debt funds also invest in treasury bills, corporate bonds, commercial papers, government securities, etc., which provide investors with a fixed rate of interest at regular intervals without any risk. Since everything is pre-decided, market fluctuations do not affect these investments, making them a low-risk investment option. Now, if it is a very low-risk endeavor, does that mean that it is 100% secure? The answer is no. Some risk is also hidden in debt securities, and to understand this risk, every debt security has a credit rating, which helps investors to understand how much risk is there in which debt instrument and what are the chances of the debt issuer defaulting. Those who are debt fund managers keep these ratings in mind, and they decide where and how much money to invest. A high rating definitely means that the chances of default are very low, but they also give lower returns. The same low-quality debt instruments offer an opportunity to earn higher returns. But people like them more because they are more secure and stable returns based on a calculated risk than high-quality, high-rating debts. Now comes an important question. Should you invest in these funds? If you are someone with low risk-taking potential and your primary concern is secure returns, then investing in debt mutual funds can be a suitable option for you. You might wonder why not invest in fixed deposits instead, as they also offer secure returns. The reason is that debt mutual funds tend to provide better returns compared to fixed deposits, and they also offer more flexibility in terms of the investment time period. In short-term debt mutual funds, you have the option of investing for 3 to 12 months, while in long-term debt mutual funds, you can invest for 3 to 5 years. Short-term debt mutual funds primarily generate income through interest, whereas long-term debt mutual funds not only provide interest income but also offer the potential for capital gains. Overall, debt mutual funds offer a good balance of security and potential returns, making them a suitable choice for conservative investors seeking stable returns over time. There are many types of funds in short-term debt mutual funds and long-term also, so let's discuss them. 1. Liquid debt mutual funds. This is a short-term investment mutual fund with a maturity period of only 91 days. If you want, you can withdraw them within 24 hours, but you will be able to get all their benefits only after their full maturity is completed. In the category of debt mutual funds, the risk is the least because their maximum validity is 91 days. So the fluctuations of the market have no effect on them, and they also give stable returns. So if you want to make a safe investment without reducing your liquidity, if you want, then this is the best option for you.
Please do comment, Like, share, and subscribe on my channel Digital Fin Mind.
Another advantage of this fund is that it is relatively low cost, with the expense ratio generally being 1% or even lower. The reason is that unlike equity mutual funds, there is no need for active management, and fund managers have to put in less effort. So if you have some cash lying at home and you don't want to invest it for the long term, liquid debt mutual funds are a very good option for investing that money. 2. Health mutual funds. In these funds, you only invest in securities issued by central and state governments. The probability of governments defaulting on these securities is considered to be almost zero, which is why they are called gilt mutual funds. The maturity date in these funds is not fixed. It depends on the government's terms, but it is pre-decided, meaning the returns they offer are quite predictable. Fund managers often invest in these funds while keeping the diversification of the investment portfolio in mind. While investing in gilt funds, there are some essential things you should keep in mind. Firstly, consider the expense ratio. This depends on your fund manager's investment strategy, but generally, the expense ratio of gilt funds is slightly lower than other mutual funds. Before investing in this fund, research and pay special attention to its expense ratio. Secondly, in gilt funds, there is no credit risk, but there is an important however. Gilt funds carry the risk of changing interest rates. If the central bank sharply raises its interest rates due to inflation or any other reason, it can have a negative impact on your fund's net asset value, NAV. Thirdly, because your gains depend on interest rates, the predictability of gilt funds decreases, and some level of risk creeps in. One significant advantage is that gilt funds tend to perform much better than other funds in a slumping market. Lastly, their maturity period is usually between 3 to 5 years, which reduces their liquidity and makes them less suitable for short-term investments. Gilt funds are considered a good investment option only for mid to long-term goals. 3. Fixed maturity plan. These debt mutual funds are closed-ended, that is, you are investing in them keeping a fixed tenure in mind, and with this, the rate of interest is also fixed, which means the chances of loss are negligible. Now you will think that it is just like a fixed deposit in which both the maturity period and interest rate are fixed. So why not invest an FD instead? The first reason is that the rate of interest in these funds is much higher than that of FDs. The second reason is that in FD, your entire investment is taxable, regardless of your tax bracket, whereas compared to FDs, FMPs, fixed maturity plans, offer negligible taxes. However, there's a twist in all this. When it comes to liquidity, FDs outshine FMPs. FMPs have lower liquidity compared to FDs. With FDs, you can withdraw your money anytime by paying a penalty, but the process of withdrawing from FMPs becomes more complicated. 4. Junk bonds. These are high-yield bonds, and when compared to regular corporate bonds, they are quite similar, with the key difference being the credit quality of the issuer. Junk bond issuers have relatively poor credit quality, often consisting of startups or financially struggling companies. Issuing junk bonds is a way for these companies to raise funds, but it comes with higher risk. Indeed, investing in junk bonds carries significant risks, but it also offers higher returns. Investors considering junk bonds should carefully assess their risk tolerance because the chances of these bonds failing or defaulting are relatively high. Only those investors who can bear such risk should consider investing in junk bonds.
Please do comment, like, share, and subscribe on my channel Digital Fiend Mind.
Now, you might think that if investing in these bonds carries so much risk, then avoiding them might be a better option. Highly experienced fund managers, ratings, and careful market analysis are the factors that lead to investments in investment grade junk funds only. That concludes the discussion on debt mutual funds. Despite not offering as high returns as equity mutual funds, their low risk and reasonable returns make them highly regarded by fund managers as some of the most balanced mutual fund options.